Well, hello, this is Rich Morrison. It is Tuesday afternoon, and welcome to my latest edition of The Thinking Cap, where today we're going to look at the charts on most of our markets that we talk about every day. I was going to do the good and the bad and the ugly, but honestly, we've got most of our markets kind of in the middle right now. So I thought it'd be good to look at each one, try to indicate where support sits, where resistance sits, and some things you might want to look at, especially for producers maybe looking to make some sales, put in some offers, some things like that here in the days and weeks ahead. So, what's going on right now? The big overview has been the funds. And if you look at what they've done in the last 4 or 5 months in the ag markets, this chart shows their net position in grains and oil seeds. And it's been an incredible buying run that they were on really from about the beginning of August, even late July, through the beginning of October. The funds reversed their short position, went from short nearly 700,000 contracts combined in grains and oil seeds, bought it all back to net positive, sold a little bit at harvest time, but now we're back on the positive side here at the beginning of, or at the end of last week. The big story last week was corn. Funds bought about 90,000 contracts of corn in 1 week. You have to ask the question, why has the corn market not rallied more? And the obvious answer is it's been farmers selling. During this big swing where the funds bought back all of this corn in August, September, that's when we saw farmers liquidating old crop corn stocks. A lot of people emptying the bins. We had huge June 1 stocks of corn. We knew that. A lot of that corn all got moved at the end of the summer. And so we saw big selling offset the buying that the funds went on. And a little bit the same here during the last half of harvest with farmers selling overflow going into the marketplace kind of was offset by the selling or by the buying of the funds. So looking overall at commodities right now, this is the Goldman Sachs Commodity Index chart, shows the last 12 months in that trade. Now keep in mind this index includes markets like precious metals. It includes the energy markets. So crude oil tends to be a big part of this index. In fact, it ends up being about 25 to 30% of the index. So, but you can see where we're at now. You know, the commodity markets in general had a pretty good start to the year, but most of that was in other markets. It wasn't in ag. Now, here lately, you know, it's been kind of back and forth. Certainly, ag, we saw that buying here from late summer from the funds helped to move that index higher. Crude oil has been back and forth a lot. We'll look at crude here just a few minutes. So, let's start out with corn. Let me move this out of the way over here to the left-hand side of the page. The corn market's been back and forth. We know that. But this big buying run from 403 and three quarters to 452 and a quarter in March corn, that was completely driven by the funds. Even with some of that farmer liquidation at the end of summer, this market was still able to rally pretty strongly. The recent rally we've had after the sell-off was, I think, really driven by export business. We've seen some strong buying from Mexico and some of the usual buyers, but they've been either front loading their buying this year or maybe they're going to buy more than we expect. But whatever the case is, this is this latest real run from the funds, and especially right here in the month of November. You know, these few days from the first into the first 5 or 6 days, that was at 100,000 contracts that they bought, or 90,000 last week. Since then, kind of been back and forth a little bit. So, what am I going to do if I have corn to sell out of the bin? As of today, market's pretty neutral. You see the RSI, the green line at 54, stochastics in the 50s, pretty darn neutral market sitting here at about 437. So I still think up around this 450 level. You know, the recent high 447 and three quarters, 452 and a quarter back in the beginning of October. Probably still not a bad place to liquidate some old crop corn. For those of you needing to turn corn into cash here at the start of the year, look at your basis opportunities as well, see where the carry sits in the market. The market has rallied to the point where we've taken a lot of the futures carry out. You've also got the 200-day moving average coming down right now at 454 and a half. So all of these things sitting up around 450 probably tells me if I was going to offer corn personally, probably put in an offer 445, something like that. The other thing I might want to consider doing if we get up there, maybe I buy an out of the money call option. Maybe I go out to March or even May and buy an out of the money call with my sale. I could hedge corn or sell corn there, get that call bought a little cheap, just in case this market does have some upside going into spring. But as we sit today, right below the 9-day moving average after today's trade, that didn't look very good. The fact that we closed a little lower here today. You do have some pretty good support down here in the low 430s, 432, 433, the 50, the 20-day moving average, and then the 100-day at 427. So, the one thing, if you look big picture at this chart, you see that we've had higher lows and lower highs as we move into winter. And that's pretty typical this time of the year in the corn market. We tend to take the volatility out of this market. We kind of reach an equilibrium where, we don't have any questions about supply anymore. We kind of know what the crop size was. Demand is starting to get, ironed out. We're starting to get a feel for that. So we kind of have an idea what U.S. stocks are probably going to look like at the end of next year within maybe 50 to 100 million bushels. So now it comes down to South American crops. It comes down to U.S. acres next spring. All of those things will eventually start to move this market. But you get a rally up to the top end of this thing, probably makes sense to be a seller. January soybeans, kind of hovering towards the low right now. I'm sounding like a broken record, but I continue to say that the soybean market, to me, is the most bearish balance sheet there is. That being said, the latest positive news has been bean oil. The soybean oil market has given us a couple of nice little rallies, gave us this little bump here at the beginning of November. We stopped the 100-day moving average in soybean futures. Now, we got bean oil that's been providing the support, but the problem with that is you got the other half of the bean crush, and that's meal. And as oil has been rallying and as crush has been at record highs, we're sitting on a lot of meal supply right now. And so the meal has been diving. We've been making new lows, new contract lows in soybean meal. And so on a given day, one day it seems like we trade the oil part of the crush. The next day we trade the meal side of things. But then the bigger story here is South America. What's going on in Brazil? Well, right now, weather's pretty good. 80% of the bean crop is planted. That's now 12% ahead of last year. So they were off to a slow start. Now they're ahead of normal and they got moisture. So there's really nothing bullish here at the moment to hang your hat on aside from this bean oil story. So again, I think kind of like corn, you get a rally, take advantage and sell it. Right now, the RSI at 45, stochastics in the 30s and 40s, probably towards the lower end of the zone. And you kind of see that on the chart. We're closer to the recent lows that we've had, this kind of double bottom in January beans, than we are any recent highs. So if I have beans to sell, probably going to look at the purple line right now, the 100-day moving average at 1032 today. I'd probably have an offer, say at 10 and a quarter. Get the market up to 10 and a quarter, start selling some old beans for cash. And again, if I want to re-own them potentially, go buy an out of the money call option, maybe an $11 March call, just in case we get South American weather problems and the market, decides to rally a little bit later on. The wheat. Wheat has had a good week so far this week. Started on Friday, good day yesterday, good day today. Last night I showed this chart in the market report and I said, first target is the 9-day moving average. We took it out today. Next is this downtrend line. Looks like we bumped up against that today. So that'll be the goal for tomorrow. That and then the 20-day moving average at 595. Now this is July wheat. This is new crop wheat. I don't want to be in a big hurry to be a seller here. I mentioned last night, I think the 200-day moving average line, this light blue line, was a good target to be doing some hedging for next year's crop. So maybe around 620, 625, be a good place to work some offers. The bearish news, of course, in July wheat has been rain. We've had plentiful rainfall in the U.S. Hard red winter wheat areas. Crop conditions have improved now 3 straight weeks. And so that's kind of kept a lid on this market. Now, this week, the big story has been Ukraine, lobbing long-range weapons into Russia. And so it seems like whenever that war escalates, we get a little bump in the wheat market. And so maybe it'll give us an opportunity to take advantage of here. By the way, the indicators, RSI at 43, stochastics closer to a bottom than a top. But I would note that the short-term stochastic line, this red line, has crossed the blue line going higher, which is a good indicator that maybe this market has started a little bit of an uptrend. Cotton, cotton has no friends. We made a new low again this morning, traded down to 68.40 in the cotton market. We're now within about a half a cent of the contract low that was made back in August. We're a long way still away. We're over 1.6 cents away from the 9-day moving average here in March cotton. Uh, RSI at 32, stochastics well oversold. This is definitely in the not zone. It's the coldest of all of our markets today. Um, where do I want to be a seller? You probably have to look at this cluster of moving averages up around 72, 73 cents as a logical return place to maybe be selling some cotton, which is not very far from just the high we had a week ago, up close to 74 cents. So I get up in that 72, 73 cent area, probably be a place to start nibbling. And then if you, again, want to stay in the market, go buy some out of the money call options. Switching over to the livestock market, big run today in live cattle. February live shot back above several moving average lines, took out the red as the 9, the 50 is the gold, the 200-day, the light blue, the dark blue is the 20-day moving average, closed above all of those lines today. So kind of here we go. You look at the indicator lines at the bottom, the RSI back up to 57, stochastics lines quickly turning higher. So good run, and I think you've probably got a reasonable expectation to run back to this 190, 191 area, kind of a double top we've had in February live cattle up here. So that would be a target if I've got cattle to hedge. Probably be looking up at that 190, 191 area as a place to be hedging, and I think it's reasonable given the direction that these indicator lines at the bottom of the page have been. But again, go back and look at some of these indicators. The RSI had been well up into the 70s back at the beginning of October. Stochastics lines very overbought back when the market was up around 189 or so. Eventually topped out, traded lower, corrected. Maybe you say that was a cleansing of the market. We got a bunch of week longs out, and now here we go again. So this is kind of a counter seasonal rally. Because normally beef this fall period into winter, normally is not a big beef season. Turkey's a big deal this time of year, et cetera. But it's kind of nice to see. And so if you've got cattle to hedge, certainly be looking ahead here up around that 190 level. Similar with feeders, similar looking chart. We've made a new high today. We crossed the 200-day moving average, first time in a long, long time. Traded up to 252 at the close. Again, the indicators probably reaching a little closer to overbought right now than live cattle. The RSI at 69, stochastics up into the 80s and 70s. I don't know if we can get back to this July high at 261, 262, but I think in that 255 to 260 area probably be a good place to be a seller in feeder cattle if you're going to be looking to doing so. And then finally, hogs. Hogs have been the strongest market up until this week. Just kind of the opposite of what we've seen in the livestock, in the cattle market. Where cattle have been rallying, hogs have been had rallied. It's been a heck of a run from August all the way to the beginning of November. We had rallied almost $20, but it was a really slow, methodical move. You can see how long the RSI had been above 70, 65, 70. Stochastics up into the 70s, 80s for, 3 months. That's just an incredible, long, sustained rally. And then finally, this market had to collapse or had to wash out. And sometimes that's healthy. And so while we have traded back below the 9 and the 20-day moving average lines, the indicators of quickly moving towards oversold, stochastics down into the 20s, 30s, RSI still at 47. I would think that the 50-day moving average line at $81 probably holds as good support. And if it does, then maybe we solidify and start to look for another chance back higher. This 9 and 20-day moving average at 85.50, 85.60, that's going to be your resistance to the upside. So if you missed it the first time around and you need to hedge hogs, that 84.50 level, probably the first target, maybe 86.50 or so, probably a second target I would have in the hog market. So what's running all of this, or one of the big pieces of the commodity sector, has been the oil market. And oil here this week rallied a little bit yesterday on, again, that story out of the Ukraine, the firing the long range weapons into Russia. We had oil rally over $2 a barrel yesterday on the day, kind of turned this market back higher. You see the RSI 49, stochastics have kind of turned higher. Now we're back up into the middle of the recent range. That recent range has been what, about 66 to $72. Right now, it closed about 69 today, so right in the middle of the range. So again, pretty neutral market, I would say right now, but kind of always keep an eye on oil because it does tend to pull a lot of the other markets with it. We've seen it in corn over the last several years. When the oil market has a sustained rally, tends to pull corn with it. A third of our corn crop is growing for ethanol now. So that's a big, big deal. And so keep an eye on the oil market as we go forward. Gold, precious metals, had liquidated from again an overbought market we had back in October. This thing was due for a correction. We had it over the course of 2 weeks. And now all of a sudden, with the threat of some people saying World War III, all of a sudden you're seeing a big influx of cash going to precious metals. And so you've seen almost $100 rally in the gold market in the last 3 days off this low. And so we've traded above the 9-day moving average today. The 100-day, the purple lines seem to provide pretty good support around 2,600. Indicator lines have turned higher. So I would look for another bounce back in this gold market. And then finally, the dollar. The dollar, again, is kind of like oil. It's one of those you have to keep an eye on. And the dollar has been on a pretty good tear over the last couple of months. We had rallied sharply. Part of that was post-election, where you saw some exuberance in the dollar, and then things kind of hit a void. We ran out of new fresh buyers. Again, the threat of war, started pulling money maybe into gold and some things like that here at the start of this week. This is a weekly chart of the dollar, but it did show that we had reached the highest level in the US dollar here last week since clear back in late 2022. So it was due for a correction as well. And we're starting to see that here at the beginning of this week. But still, we're not even down a full point. Closed today at about 106.2. That's still we're still only 7/10 of a point down from this high. So a weaker dollar would help export sales. A strong dollar is not good for export sales. And so export sales have slowed down a little bit in recent weeks. And so we'll see this Thursday what the sales numbers look like. So with that, just a quick reminder, don't forget our marketing services, the opening bell phone call every morning, the market report email, the aftermath webinar we do the day following the USDA report, these thinking cap videos. If you want to subscribe, go to our YouTube channel and do that. You'll automatically get updated when one gets posted, and just a lot of different ways we want to keep information in front of the growers that we work with. So with that, thank you for listening to this week's thinking cap video. Hope you have a great one. We'll talk to you again very soon.